Hi, I'm Julia from Zillow. Today is the start of something really exciting, a once-a-month, multi-part video series that's presented by Betterment as a part of Ask Zillow Anything, which you might recognize me from. In this series, we'll be covering the basics on how to prepare your finances and evaluate the big decisions in buying, building, selling, or renovating your home. We're bringing together experts, customers like you, Zillow partners, and employees to help get you that information. And why are we doing this? Because you asked us to, literally. Those were all real questions that have been sent to Zillow. And no surprise, a whopping 88% of recent home buyers surveyed in April of 2021 said that at least one aspect of the buying process was stressful. I certainly get it. If I didn't work here, I wouldn't know where to start. But thankfully, you don't have to go at it alone. You've got allies, and the agents you'll work with, our partners across the industry, as well as all of us here at Zillow. After sitting around for longer than normal in 2020 and 2021, I doubt that I'm alone in thinking that I could use a little bit more fitness in my life. And I'm not just talking about working out. You might not think about your finances in terms of fitness, but it can be helpful to think of them this way. After all, you're trying to build up enough financial muscle to wrestle yourself a house. And much like working out and muscle, there are certain financial decisions that you can exercise frequently to strengthen your position. These can take time, so it's a good idea to start preparing today. Some things will seem obvious, such as budgeting, but others are more complex, which is why we're here to help clear things up a bit. And to help us out, we've brought a special guest here today. Wait, I'm not quite dressed for this next part. That's better. Let's meet our guest. Hey, Ashley, could you introduce yourself?
Thank you so much for having me. I'm really excited to be here. I'm Ashley Feinstein Gerstley. I am a money coach, author, and the founder of the Fiscal Femme. I love making complicated, daunting, inaccessible topics available to us so we can reach our financial goals. I love the term financial fitness because it is so equivalent to our physical fitness or our emotional fitness. It's something that's really personal to each of us. It's a process. It's something that we have to build and takes time and is a habit, just like our money. And it's really about feeling good with our money, understanding what's happening with our money, and knowing what we want, what our goals are, and building those habits and working towards them.
Nice. To start, let's examine one of the more complex, even confusing aspects of getting financially fit and ultimately preparing for a mortgage: credit score. When asked 5 questions about credit scores in February of this year, the average American answered only 2 correctly. The credit system is complex, it's not entirely transparent, and so of course, there's plenty of confusion around it, as well as a few things about how credit scores are calculated are counterintuitive. So Ashley, can you explain credit scores?
Definitely. Our credit score represents how risky it is to lend us money. And it's in a number that typically ranges from 350 to 850. Your credit score is really important as a first-time home buyer because our credit score can determine whether or not we can get a mortgage or a loan, as well as the interest rate we get on that loan. And when we're talking about a loan that's as large as a mortgage, percentage points different in interest rate can save us thousands, if not tens of thousands of dollars over the course of us paying off that loan. You might think that there would be one credit score that we are all measured by, but that would be way too easy. So there are a few that are more common. The most common is the FICO score. A second runner-up is the Vantage score. So when we talk about how our credit scores are calculated, it's helpful to talk about one of the most popular. So let's break down how the FICO score is calculated. 35% is payment history, 30% is amounts owed, 15% is your length of credit history, 10% is new credit, and 10% is mix of credit. If you're looking to build up your credit or increase your score, it can take time, but here are some best practices that can help you do so. The information that goes into our credit score comes from our credit report, and there are 3 credit agencies that have credit reports: Experian, TransUnion, and Equifax. And the information in these reports is really important because they are the information that feeds and determine our credit score. And every single year, you can check all 3 of these reports for free at annualcreditreport.com. And the reason this is really important is a lot of times these reports have errors, and sometimes the errors in them actually are negatively affecting our score. So if that's the case for you and there's something in there that's negatively affecting your score, remedying that error is the quickest way to get your score up. Another way to increase our credit score is to set up automatic payments on our bills and our credit cards so that you never miss a payment again, and that really helps that payment history. Another way to increase your credit score is to decrease your credit utilization, which we know is that 30% part of the pie that makes up your credit score. First, if you have credit card debt, you can work to pay that down. That will automatically decrease your credit utilization. You can also pay off your credit card throughout the month so that that balance is never high when the credit agencies are checking it. And then also you can increase your credit limits by calling up your credit card companies and asking for a larger limit. But that comes with a big caveat that that's only a helpful tip if you're able to not spend more or build up more credit card debt. It's also helpful to keep older accounts open because that impacts the average age of your accounts as well as what your oldest account is, which impacts your length of credit history, which makes up 15% of your credit score. If you have time and you're looking to build your credit or increase your score, you can also open a credit card if you don't have one. And if you're unable to open a credit card, you can open a secured card, which is a card where you give the bank money and they give you a credit card for a certain limit. And so that way you're building that relationship and able to increase your score. You can also become an authorized user on somebody else's credit card, like a friend or a family member. Just, it's important to remember that you are now tied to them as far as your credit. So you want to only become an authorized user on someone's account if they are going to be paying their bills on time.
Awesome, Ashley. So what happens if you find yourself in a rough financial situation as it relates to credit score? And what does that mean for first-time buyers?
If your credit is not where you want it to be, you still have options. It's important when you look at those options to actually run the numbers because sometimes the fees and the interests make them not worth it. So to get those options, talk to a lender, or better yet, talk to 3 lenders so you can compare and negotiate. And know that there are conventional loans available for those who have credit scores typically above a 620. There are also FHA loans, which stands for Federal Housing Administration, where your credit score can be anywhere above a 580. Unfortunately, like every area of personal finance, there are scams to look out for. A credit repair company can remove something that's on your credit report in error, or they can monitor your account for theft and repair it after identity theft or fraud, but they cannot wave a magic wand, and it does often cost money. So if a credit repair company promises to remove something that actually happened, like you were 60 days late on a payment, that is a sign that they are a scam. They can remove things that you could also remove, but they just have the processes down and it saves you time to use them.
Great point, Ashley. I've read that credit score is only one of the factors lenders use to evaluate a potential borrower. Can you help me understand what a debt-to-income ratio is?
Our debt-to-income ratio is our total monthly debt payments divided by our gross monthly income. And your gross income is your income before taxes, deductions are taken out. So to calculate, there's 2 typical debt-to-income ratios that lenders look at. The front-end debt-to-income ratio includes your new housing costs. So it's your monthly new housing costs, your mortgage, your insurance payments, your HOA fees if you have them, divided by your gross monthly income, which is that gross income divided by 12. The back end debt to income ratio is looking at your total debt, including your new housing costs. So if you have any student loans, credit card debt, those payments as well, divided by your gross monthly income. If you are looking to decrease your debt to income ratio, paying down debt is a great way to do that. The first step to paying down debt is to take inventory of all your debt. That means listing out each piece of debt, and you can name it by who the lender is or what you call that piece of debt, your balance, your interest rate, your monthly payment, your payment date. And if it's a credit card, you can include the minimum payment as well. And I know that this process can feel really painful. I call it facing the numbers, but debt is just money you owe for something you bought. That's all it is. So as painful as this might feel, we cannot make a plan to pay down our debt until we actually know what debt we have and all the information around it. From there, we want to prioritize our debt. So what are we going to pay down first? And next to that list of debt, we're going to list out what's first priority, second priority, all the way down the list. And in order to prioritize our debt, I like to use 3 different strategies. So the first is the snowball method, paying down the debt with the lowest balance first. And the reason we would do this is it feels really good to cross something off our list, and that builds our motivation and gets us excited about paying down our debt. And once we have that first piece of debt paid off, we can put that debt payment towards the next piece of debt. The second method is called the avalanche method, and that is paying off the debt with the highest interest rate first, because that debt is technically costing us the most money because we're paying the most interest on it. The third method is something I added based on my work with clients. A piece of debt might not be the smallest piece of debt or have the highest interest rate, but it's the piece of debt that causes us the most emotional stress. And that could be working with a bank that you've had a really terrible experience with, or even a loan to a friend or family member that's 0 interest, but you really just want to get that paid off. So that can impact how we prioritize. And then from there, the recipe for paying down debt is essentially starting with priority number 1. We're paying down for each piece of debt. We're paying all of our payments. We're paying our minimum payments or what our monthly payments are, because that impacts our credit score. We want to be on time with all of our bills and our debt. And then from there, any additional money goes to priority number 1. And once we pay that off, the amount that we've been paying to priority number 1 can now go to priority number 2. And we work our way down the list.
Want to know your debt to income ratio? Zillow's got a calculator for that. And you can use that as a starting point for your own budgeting when taking into account other regular monthly expenses you have. So are there factors to consider when providing proof of income to a lender?
When you go to get your mortgage, you're going to have to prove your income so that the lender knows that you have money coming in to make your monthly mortgage payments. Proving your income can be a lot more difficult if you are not in a salaried job where you have a W-2. If you are a contract worker or a freelance worker, there's going to be more requirements for your proof of income. You might be able to avoid that if you are buying a home with a partner who does have a W-2 income or a salaried income. The documentation you'll need for a proof of income is either your W-2, which is the document you have when you're in a salaried position, a 1099, which is for freelance and contract workers. You will also need a few recent pay stubs, and if you're using income from a bonus or a commission, you'll also need the pay stubs that has that information on it, as well as some tax returns. And for those who are running their own business, you'll also need some profit and loss statements.
Thanks, Ashley. Let's build on that. After establishing proof of your income, one of the first things you'll discuss with the lender is how much you'll need to borrow in order to buy a house in your target price range. While we'll talk about how you can determine that price point sweet spot in the next few episodes, for those of you who can't wait or who are already in the thick of your housing search, consider using another free Zillow tool, our affordability calculator, which can help you determine how much of a down payment you need.
A question I get all the time is, how much money should I put down on my home? What should my down payment be? And the down payment is typically the most significant cost when it comes to our mortgage by far. What it really comes down to is running the numbers. Run some rent versus buy calculators. There are so many inputs that go into making this decision. Feel free to run it by your lender, a financial planner. Homeownership is often the biggest financial purchase in someone's life. And so it's going to take time to save up for that goal. And if the time is not now, that is okay too.
Nice. That's a good point. First-time home buyers have more options than most to put down less upfront. Zillow research shows that first-time home buyers with a mortgage in the United States typically put down 10 to 19%, though that percentage will trend towards the higher side in a more competitive market. So how much should you plan to put down? Well, like most things related to real estate, it's not a simple answer. There's more to down payments, but we'll get to that in the next episode. For now, you're in a great place to start your financial fitness plan. Ashley's going to break it down for you, step by step.
Here's what you'll want to have on hand and ready when you're going into the home buying process. Your credit. You want to understand what it is and have it built up as much as possible. You'll want to know your debt to income ratio and have a plan to pay down debt or increase your income if you're looking to improve it. You'll need your proof of income, the W-2s, 1099s, pay stubs, and tax returns, all handy and ready to go. You'll need your proof of funds for the down payment. That's your bank statements, your retirement accounts, your investment accounts, proving that you have the funds. You'll need to prove your identification, so that's either through a driver's license or a passport. And you'll want to understand the financial assistance programs that are available to you. And if you're going to be utilizing one, any extra documentation you'll need for that process. What's great about saving for a home is we're often really motivated to do so. So it works really well to have a visual representation of a home or the home that looks like the home you want, either in your wallet, on your desk, on your fridge, to remind yourself of it often. And then every time you go to make a purchase or have a spending decision, you can weigh it against this goal you have of buying a home. And when we're saving for something that's really big, like a home, the numbers can feel very daunting. So it can feel like the $5 I'm putting aside each week or the $20 I'm putting aside, it's gonna take me thousands of years to save up for a home. But I want to remind you that our goals are not linear. When we're building good financial habits and we're saving, our progress can be exponential as we're learning new skills and building that muscle. I hope this was really informative and you feel financially fit and ready to enter the home buying process.
Well, that's all the time we have with Ashley today. Thank you so much for joining us. It was great chatting with you.
Thank you, Julia and Zillow, for having me. Hopefully this makes the home buying process a lot less daunting and confusing.
That might seem like a lot, but there's a great deal of support along the way to help you conquer each step. From Zillow's free calculator tools to conversations with lenders and agents to assistance programs for first-time buyers. You can get the information and tools you need to figure out the right home for you pretty quickly these days. It's what Zillow and its affiliates do, help people make their next move. To dream, to find the right place at the right price, and ultimately to grow. And if you break these preparations into manageable chunks, they won't seem so overwhelming. Today is just the start. But by the end of this series, you'll be feeling on top of it all, ready to take the next big step and move.